what's up guys, it's Jonathan here. Oh my goodness, what the FOMC did to the market today was absolutely brutal. We got a lot to talk about and there was a lot of good tidbits from that meeting. So the Federal Reserve raised interest rates by 75 basis points. This was widely expected by almost everyone in the market, with about a 90% chance of happening as of this morning. And there are some important things that Jay Powell said during the FOMC press conference that I really think we need to highlight. So as always, he started off with their goal, with the FOMC's goal is to get inflation to 2% in the medium term. By that they mean within like next 3 to 5 years. And they plan to get to this goal by raising rates to a restrictive zone and reducing the balance sheet. We've all heard this a million times before. It's like the same old news. He also did mention that economic growth has slowed since 2021 and that GDP is flat for this year, for 2022. He did also talk about how higher rates are slowing down business investments in real estate, as we've all seen from the rapid rise of real estate rates, and also the reduced earnings and corporate profits that we've seen from quarterly reports as well. So he did also mention that labor markets are still out of whack, but he does acknowledge the slowdown in job openings in certain parts of the economy, as we've seen not only in the JOLTS job report yesterday, but also the ADP job report this morning. He also mentioned that inflation expectations appear to be well anchored, which for the most part is pretty true, but for the past month or so, we have started to see some of the break-even rates, which pretty much measures the expectation of interest rates in the near term, so like within the next 2 to 5 years. And also in the University of Michigan Consumer Sentiment Report, we have seen an uptick in inflation expectations. So even though they are still pretty well anchored, they're not necessarily well anchored. So I thought that was a little bit weird wording for him to use. But I will give him the credit that they are relatively low from the highs we saw in April. And he also did mention that the FOMC does believe that there will be more rate hikes will be necessary to be able to bring inflation down to a 2% goal. He actually did acknowledge that it will take time for the effects of higher interest rates to actually show up in the economy, which he has never said that before throughout this whole rate hike cycle we've been in. He also did mention the FOMC will consider this before they consider additional rate hikes, which was very bullish, and we did see the market start to move up on this news. And Jay Powell ruined that by saying that they don't know how high interest rates will have to go to get inflation to 2%. And obviously the market didn't like this because that means that there's more rate hikes ahead. So the market did soften up a bit on that statement. And he also did follow that up with even more bad news by saying that, which means most likely expect a higher terminal rate on the SEP in December's meeting, which for reference, SEP means Summary of Economic Projections. As usual, they did say that they will continue to respond to future reports and adjust their actions accordingly to those reports. And they also say that inflation reduction will require, quote, below trend growth, which is pretty much a recession. That's pretty much saying that growth needs to slow down, which, 2 negative quarters of GDP growth is a recession. So pretty much that's what that means. And they also said that they also need to see a softening of the labor market, which usually means higher unemployment rates. And Jay Powell also did state in his opening statement that the Federal Reserve will not prematurely back off, and that they would much rather over tighten and then have to turn around and stimulate rather than under tighten and have the possibility of a wage price spiral. So moving on to the Q&A section, when Jay Powell was asked what is needed to see a slowdown in rate increases, he mentioned that they need to see inflation come down significantly, and they need to see it come down significantly in a series of down read-ins from not only jobs but also inflation as well. He was also asked, does the FOMC predict another 75 basis point increase in December? Jay Powell, the way he answered this was pretty much, he said that it's important for them to hike fast to kind of smother the ideal of a wage price spiral and entrenched inflation. That they will need to not only hike fast, but also hike to a restricted level. And like I said, given the strong reports we have seen recently, that level will be higher than they previously expected. He also stated that the slowdown of rate hikes will come in the next two meetings, but that again, that is data dependent. He also mentioned that the speed right now is less important than the terminal rate and the length of the increase at that terminal rate. So really, they're looking at the speed it takes for them to get from zero Fed funds rate where they were at all the way up to whatever the terminal rate is, and then also the amount of time that they're going to stay in that restrictive level before they bring rates back down. So when he was asked about does the Fed funds rate need to be higher than PCE rate to get inflation under control, this is a very common thought about concept from a lot of people in the finance space, is that they think, okay, if you want to get inflation under control, you need to make the Fed funds rate as high, if not higher, than the inflation rate. This was what Paul Volcker basically did. I think inflation was at that time like at 12%. They just went out and made the Fed funds rate at like 13%. And pretty much tried to almost, you could say, smother inflation. Jay Powell, when he responded to this, basically said that yes, he does believe that at some point the Fed funds rate will have to get higher than the PCE rate to be able to control inflation. But he also did mention that increased borrowing rates don't necessarily affect consumers on their day-to-day spending. And personally, I've been saying this for a very long time, like, how many, most people don't even know that the FOMC raised rates by 75 basis points today. Like, even though, like, all of you may know, everyone who's watching this video may know, you have to understand that, like, this community makes up, like, a very small portion of the general population. This stuff doesn't necessarily affect people's day-to-day life, and most people don't even know we're in a recession until, like, they start losing their jobs, or until people start getting pay cuts, or they start losing their jobs, and then their friends lose their jobs. So it's one of those things where, yes, raising rates is a way to kind of slow down the economy, but it doesn't necessarily slow down consumer spending. And the unfortunate thing about it is that we're really going to have to see people not only spend the savings that they have from their increased wages and all their savings they have from COVID, but also we're going to have to see people get into debt and then use up all of their debt that's available to them. And then we'll start to see a slowdown in consumer spending. And I mean, think about the data we just saw with the JOLTS report and even the ADP report this morning. Where's the biggest growth in jobs, when you think about it from a sector by sector perspective, was hospitality and restaurants. And they were the most job openings in comparison to like every other sector, and wasn't even close. So we really need to see people kind of spend off all of their spending power before we really start to see a cool down in those areas. But I do think that we will eventually see some kind of cooling in those industries. So moving on, when Jay Powell was asked about the risk of inflation becoming entrenched, he basically said that he doesn't believe that, and that expectations for long-term inflation are still relatively low. But he also did mention that the Fed doesn't really have a gauge to be able to tell when inflation becomes entrenched. And basically that if the Fed starts to see that inflation is entrenched, it's basically already too late. So that wasn't very, bullish for the market either. And again, it kind of supports his thinking behind, okay, let's just hike and hike and hike and hike. And who cares if we take the economy into a recession? We can always just stimulate our way out of the downed economy. So, it kind of just feeds into that thinking a little bit more. When he was asked about lag time of the Fed's actions, because generally speaking, when you increase interest rates or you kind of do any kind of restrictive monetary policy to the economy, it generally takes anywhere from 6 to 18 months to actually feel the effect of that policy change. And then he kind of went into this talk about how, like, in a modern economy, generally speaking, it's usually believed that when you tighten markets, then that affects financial markets, and then financial markets affect consumer spending. But now, since we live in a modern economy where information flows more freely, and that the market tries to front run the actions done by the central bank, that line of thinking might not actually be true anymore. And this kind of makes sense because we've seen the Fed do it kind of. They try to talk down the market, or they try to say, oh, we're not done yet, or we're not close to being done yet. So, yeah, we still have a lot of hiking to do. All that kind of talk that they do, that's basically what they're talking about, is that they could just talk. And by them just talking, they could talk down the market without them even having to do anything. And then he also went on to say that the FOMC is nowhere near pausing, and that there still is a lot more work that they need to do. Again, that did send the markets down quite a bit. Then he was asked if he thinks that the Fed's actions are causing permanent damage to the housing market long term in terms of supply of homes. He went on to say how the housing market was, after COVID, was very overheated, and that there was a need to get things in balance between supply and demand. And that's almost reiterating what he said, I believe, in the April FOMC meeting. It was one of the earlier FOMC meetings this year. I kind of forgot which month. But he did say something like that homeowners actually need a restart, and that right now supply and demand in the housing market is extremely out of whack. And then he kind of went on talking about how this isn't like the 2007 housing crisis. The people who own homes now are very well qualified, and that there's much tighter lending standards. But he did talk about how the relaxation in the housing market is actually helpful to reduce inflation, mostly through the wealth effect. And the way the wealth effect works is that when people see their balance sheets are doing very well, they're more likely to spend more money. And pretty much what a balance sheet is, it's like a homeowner's balance sheet would be like their net worth. So then he was asked about, is a soft landing still possible? And basically his answer was yes, but the window is starting to get narrower due to the continuously high elevation readings that the Fed is seeing. And he supported his position of a soft landing mostly behind the fact that there is so many job vacancies that even if they do tighten, it won't necessarily increase the unemployment rate. Basically, for me, personally, I believe that it will still all depend on the data. If we still get high inflationary reads, high job reads, then I think, yes, we still are going to get these 75 basis point hikes. But if we start to get readings that are cooler, I think then we'll start getting those 50 basis point hikes. After a couple of those periodically lower readings, then we'll eventually start to see 25, and then we'll see an eventual pause. So, and I think that the market is pretty much in agreement with me that that's basically the way it has to go. I think right now the market is adjusting more for the bullish side of that, which is the U-turn starting in December. In my opinion, I think it could start in December, but I think it most likely won't start until sometime early next year. So basically the strategy is, hey, if you have cash, I can't give you personal financial advice, but for me personally, like, I am basically all in the market. I have all of my cash deployed. Any new cash I'm getting, I am deploying it. I don't think this is the market you want to be sitting on the sidelines on, especially after we've seen all of this pain in the market. I think that even the QQQ now is near some of its inter-year lows. So personally, I would be a buyer of stocks, but that decision is completely up to you. So that's pretty much all I got for you guys. Thank you so much for watching, and I'll see you in the next video. Peace.